Chairman. Bismillah ar-Rahman ar-Rahim. Good afternoon, ladies and gentlemen. Let me start by thanking Lariba for giving me this opportunity to address such a prestigious gathering. As Mahmoud said, accounting is not usually a popular subject, and I'll do my best to keep the technicalities out and make it a bit interesting. In my presentation, I'll focus on three issues. The importance for the Islamic financial service industry of developing a global accounting and financial reporting framework, a global prudential and supervisory framework consistent with internationally recognized best practice in the overall global finance industry, and thirdly, a global Sharia framework. I'll start by discussing the issues of a global accounting and financial reporting framework for the Islamic financial service industry. We all know that the supply of relevant and reliable information regarding all material matters relating to Islamic financial institutions is indispensable for ensuring good corporate governance and for protecting investors. A strong disclosure regime which enforces certain minimum disclosure requirements will also, I believe, lower the cost of capital of Islamic banks by improving the environment for domestic and international investment in the Islamic financial service industry, and by increasing the credibility of and confidence in Islamic financial institutions. Now, disclosures have to be made in such a way that they are reliable, comparable, and comprehensive, and in sufficient detail to enable the users of financial statements to assess the stewardship of the institution, and also to help these users to make informed economic decisions. Now, the quality of information that is provided to the markets is best ensured by the application of a high-quality set of standards, which is applied consistently across national boundaries, in my view. Because implementing an internationally recognized set of financial reporting standards is an indispensable means to preserving and enhancing the quality and the credibility of the Islamic financial service industry. Now, in today's global economy, where institutions operate across national boundaries, the ability to use one set of accounting standards for all purposes has the potential to achieve economies of scale for the Islamic financial service industry and to generate considerable cost savings. This will reduce not only the cost of preparing financial statements, but also the cost of auditing, as well as the costs incurred by financial analysts and rating agencies in assessing Islamic financial institutions. However, the most important benefits will be in terms of improving the efficiency of the capital markets. The provision to the market of high-quality, transparent information on a comparable basis will reduce uncertainties in the information available to the market to be on a comparable basis to the situation in the conventional financial institutions. Consequently, it should lead to a reduction in the cost of capital of Islamic banks, because investors, both shareholders and investment account holders, could not reasonably expect returns higher than those of conventional investments with similar classes of risk. Indeed, we know that numerous empirical studies have concluded that the more information you provide on a standardized basis, the lower your cost of capital will be. This also makes intuitive sense. More comparable information means less uncertainty, and hence the lower degree of risk that has to be factored into the price of capital. When I was at the Accounting and Auditing Organization for Islamic Financial Institutions, which is known shortly as IOFI, we made the start by developing a core set of accounting, auditing, and governance standards for Islamic financial institutions, working together with relevant parties from all over the world. We worked in conjunction with regulatory bodies and international standard-setting bodies to have such core standards adopted across the globe as benchmarks for the Islamic financial services industry. I'm sure that many people who are not familiar with the work of IOFI may be thinking that our aspiration to have global strategies and standards is undermined by the fact that IOFI has developed a separate set of standards from those issued by, for example, International Accounting Standards Board. This is not the case. Let me tackle this issue briefly. Islamic banks do not accept or lend funds on an interest-bearing basis. Rather, for mobilizing and allocating funds, Islamic banks use different types of contracts that have specific provisions not usually catered for in similar contracts used by their conventional counterparts. Hence, many of the items in the financial statements of these banks are different from those that appear in the financial statements of conventional banks, and vice versa. This has important consequences for accounting standards. For example, the disclosure requirements of International Accounting Standards, which deals with banks, are largely inapplicable to Islamic banks, and hence are not effective disclosure standards for such institutions. There are also problems with the measurement aspects of certain accounting standards, where international accounting standards do not address issues that arise because of the specificities of the Islamic banking transactions. The Islamic financial service industry recognized such problems and established IOFI to address these issues. IOFI's accounting standards are complementary to, rather than being in conflict with, international accounting standards. We viewed the role of IOFI as filling gaps in international accounting standards, which do not have specific provisions to deal with the typical transactions of Islamic financial services. Without IOFI filling the gaps, international accounting standards would have allowed those preparing and auditing the financial statements of Islamic banks to have considerable scope for cherry-picking and making ad hoc interpretations of international accounting standards, a process that would result in rendering the financial statements prepared by the institutions less transparent than conventional financial institutions and non-comparable therewith, as well as spawning inconsistencies between the accounting and auditing of different Islamic financial institutions. So far, the banking supervisors in a number of countries such as Bahrain, Sudan, and Jordan are now require Islamic banks either to comply with IOFI standards or, as in the case of Saudi Arabia, are specifying IOFI standards as guidelines. In Qatar, the central bank has developed standards based on IOFI standards, and I understand that Qatar will now converge fully to IOFI standards. Let me now move on to the second issue of developing a global prudential and supervisory framework consistent with internationally recognized best practice in the overall global finance industry. We must ensure that Islamic financial institutions are regulated and supervised to internationally accepted standards in order to maintain and enhance the confidence of the industry's participants, to ensure that these institutions are subject to the same prudential standards regardless of their country of domicile, thereby achieving a level playing field for all participants within the Islamic financial service industry, and to win the respect of governments, regulators, investors, and users of funds in non-Muslim countries so as to enable Islamic banking and finance to be more integrated into the mainstream of global finance. As many of the studies into the East Asian crisis of 1997 and 1998 have found, although most of the financial institutions that experienced difficulties were complying with their national rules and regulations, many discrepancies were found between national practices and international rules. My proposition is that as the well-being of a country's financial service industry has implications for the whole economy and stability of the country, the experience of the East Asia crisis shows that the regulation of the Islamic financial service industry is too important to be left to individual countries or regulatory authorities alone. As with the accounting and auditing situation, Islamic financial institutions are currently exposed to different prudential and supervisory standards. These depend upon the country in which they operate. This, it can be reasonably argued, is mainly owing to the lack of proper understanding of the work of Islamic financial institutions, and also because of the implementation of different accounting standards. In today's global economy, when Islamic financial institutions are appearing all over the world, it is simply not acceptable to have Islamic financial institutions in different jurisdictions complying with different prudential and supervisory guidelines. We need to set our sights on having a level playing field regardless of the jurisdictions in which an Islamic financial institution operates. For example, when two Islamic financial institutions in different countries say they have a capital adequacy ratio of 12%, these ratios have to be strictly comparable. We need to compare apples with apples. It is satisfying to note that countries such as Malaysia, Bahrain, and Sudan have led the drive towards developing specific regulatory guidelines to the Islamic banking industry. However, it's difficult for countries which do not have extensive Islamic banking experience to develop similar guidelines. It is more efficient and cheaper to develop uniform international regulatory guidelines, leveraging the experience of those who have had the most experience with the industry and the issues that it has raised. To this end, IOFI, together with the International Monetary Fund and the Islamic Development Bank, organized a conference on the regulation of Islamic banking in the year 2000. One of the major recommendations from that conference, which was endorsed by many central banks, was the establishment of the Islamic Financial Service Board, or what is known as IFSB. At present, the full members of the IFSB Council comprise Bahrain, Indonesia, Iran, Kuwait, Malaysia, Pakistan, Qatar, Saudi Arabia, Sudan, and the Islamic Development Bank. There are many applications being processed at the present time for other countries to join. Malaysia is the host country of the IFSB. I'm honored to be appointed the first Secretary General of the IFSB, which serves as an international standard-setting body of central banks and monetary agencies, and which is entrusted to ensure the stability of the global Islamic financial service industry by developing prudential standards and promoting international best practices in the regulation and supervision of this industry. In advancing this mission, the IFSB will promote the development of prudential and transparent financial services through introducing new or adapting existing international standards consistent with Islamic rules and principles, and will recommend these for adoption. In addition, the IFSB will focus on the development of risk management instruments and the cultivation of sound risk management practices. It will facilitate the implementation of robust risk control mechanisms in Islamic financial institutions through research, training, and technical assistance. Its focus will encompass the adoption of present international best practices or risk management standards, as well as the development of new risk management techniques in conformity with Islamic rules and principles. In this respect, the IFSB comprises aspects of the mission of the Basel Committee on Prudential Matters and aspects of that of the UK Financial Services Authority in relation to good practice for other financial services, namely insurance, capital markets, and investor protection. Let me now move on to the issue of developing a global Sharia framework. At present, in most countries, Islamic financial institutions have attempted to self-regulate the process of complying with Sharia precepts by appointing their own Sharia boards consisting of part-time members. Not surprisingly, the terms of reference of Sharia boards vary widely from institution to another. Each Sharia board has complete discretion as to how it performs its work and expresses its opinion. This has resulted in a lack of standardization for Islamic banking and finance transactions, a situation which again makes the financial statements of Islamic financial institutions non-comparable. Most of the accounting, prudential, and supervisory issues that arise in the Islamic financial service industry result from Sharia rulings, and hence it is imperative that we work together towards developing a global Sharia framework. If we do not make progress towards harmonizing Sharia rulings, our work relating to harmonizing accounting, prudential, and supervisory standards will be undermined. The example that always comes to mind is, for example, when a default in the payment of the Murabah installments, should it be booked in the income statement or paid out to charity? You book it on the income statement, you show higher profits, while the other banks who are forced to pay it out in charity recognize a lower profit. At AOFI, we established a Sharia board in response to an initiative of Islamic financial institutions. The Sharia board has members from different Islamic countries with the aim of harmonizing Sharia rulings between Islamic financial institutions and across national boundaries. So the board's own development and promulgation, or through the board's own development and promulgation of Sharia standards. The Sharia board's pronouncements of AOFI are intended to be used as a benchmark for the Sharia rulings of Sharia supervisory boards in Islamic financial institutions. This approach should support the development of the Islamic banking and finance industry, and hence both its transparency and its credibility. However, there are those who believe that the AOFI Sharia Board should have adequate representation of the various schools of Islamic jurisprudence and to broaden the composition of its members to include representatives from relevant sectors of the industry to provide specialist knowledge, for example, in banking, finance, and accounting, and that its Sharia scholars should have the required expertise in the various specialized areas of Islamic finance and banking. I believe these are genuine concerns and that they should be addressed in the ongoing development of that important board. In this regard, the IFSB could contribute, especially since it will be issuing codes of good practice, and Sharia precepts are central to the business ethics of Islamic financial institutions. Let me conclude by saying that in today's world, any country that takes a purely national approach to regulation, especially in those aspects relating to Islamic banking and finance, is likely to be viewed with suspicion by the market, and the Islamic financial institutions based in that country may be disadvantaged. The challenge facing the Islamic financial service industry is to ensure that we take an international approach to regulation, since whether we like it or not, we live in a world where national boundaries have become less relevant, especially in finance.